Good morning and welcome to the latest iteration of Nedgroup Investments Insights. Today we are chatting with Andrew Parsons from Resolution Capital all the way from Sydney, Australia. So please bear with us if there are any technical problems we have. We'll endeavour to reconnect for 5 minutes and then we might have to make a plan. But bear with us. They're our best of breed partner on Nedgroup Investments Global Property Fund, and they've been doing a fantastic job of resilience in the first 3 months of this year. So thanks for joining us, Andrew.
Thanks, Rob. Great to speak to you, and good morning to everybody.
So the market pullback has been particularly severe on listed real estate securities around the world, despite the contractual rental income that should support valuations relative to other sectors. With the global real estate index, it's fallen 6% more than the MSCI World in the first 3 months of the year. You know, another blow as money has fled market uncertainty in the UK. We've also seen open-ended unit trusts closing their doors or closing to redemptions, which means investors in those open-ended funds can't actually get their money back at the moment, unlike the listed real estate sector. So my first question really is what's your view on the aversion to property assets in the current environment? What's driving this negativity towards the real estate sector?
Yeah, look, Rob, it is disappointing. Let me be clear about the overall performance of the sector. I think to some degree, some of the issues that have actually been coming to bear have been issues that frankly have been there for some time. And in fact, and I'll touch upon them, but in fact what's happened here is that it's actually fast-forwarded the issues to a point where they're now, basically it's the day of reckoning that's been, as I say, fast-forward. And the key sector that's experiencing that is clearly retail property, which is around about 20-25% of the benchmark. And some of the retail stocks are off 50, 60, 70% in the last three odd months. So that's had a huge bearing on the overall performance of listed global real estate. And what again I highlight is that these retailers is basically been going through a gradual deterioration associated with e-commerce and the rise of e-commerce and online shopping. And obviously in some markets it's a little more developed or advanced, and obviously the UK has seen that to a certain degree. But now we're seeing the rest of the world now having to confront this issue so dramatically, with the number of stores being shopping centres closed, etc. And so with that, that's been a huge weight on the sector. And as you know, we've been underweight the retail category now for quite some time. Elsewhere, smaller areas or areas which have been vulnerable, particularly would be, say, senior housing. And obviously senior housing, unfortunately, the occupants are the more elderly, and they are the more vulnerable to what's going on associated with the virus in terms of mortality, and therefore anything to do with, shall I say, senior housing has been hit particularly hard. And then, of course, the other major area, albeit it's not a big part of the benchmark, that has been hit very hard has been hotels. And clearly hotels have, again, borne the brunt of the impacts of the virus in terms of putting a stop basically to tourism, so that occupancy levels have fallen from, near 70, 80% to literally 10 to 20%. So that's been why property REITs have been hit so hard. It's also a case that, as we've highlighted in the past, they've been a great source of liquidity. And obviously with cash flows and liquidity drying up in many parts of the economy, listed real estate has been the go-to area to produce or provide liquidity. So ironically, it's a highlight of the sector that in fact it's continued to operate, because what we've got in the direct transactional market is we've basically got a market that's come to a stop. It's a non-functioning market, and as a consequence, investors who need liquidity are going to that area which remains open, and that is the stock market and unlisted REITs. Look, that's not to say that other parts of the market, the REIT market, haven't been impacted, but clearly the best performing areas have been stay-at-home parts of the market, residential, the data centres and cell towers, and also the logistics space, where obviously e-commerce is carried on. And so, we have had massive divergence in performance, with, again, the winners being, as we call it, the at-home, the residential, the towers, cell towers and data centres, whilst, dare I say, the vulnerable being retail, senior housing and hotels have been, particularly smashed.
So within those sectors there, you didn't mention office. How is that faring? I mean, given the length of contract that you see on those lease agreements around the world, how's office been faring? Is it quite diverse within that?
Yeah, office it's not quite as clear cut. It's interesting that you picked that, but the office hasn't been quite as clear cut. There has been some quite significant divergence. Look, it's fair to say that one of the challenges we've got is operating in this information vacuum. Is we don't know the extent to which tenants are going to, in office and in other areas, but in office, how many are going to experience rent-free, how many are going to experience rent deferment, and how many are going to be, frankly, bad debts. And so office, we're going to be curious to see if this is a V-shaped, a U-shaped, or an L-shaped recovery. Now, obviously, it's looking less likely like a V-shape, albeit there is still some people who believe there'll be people come out of hibernation and have to quickly get things done. We're not of that view. We think more likely a U or L shape. And if that's the case, then what we are going to see is some office vacancy rates really start to escalate quite materially, because we have been, and we've highlighted in past presentations, we've been somewhat concerned about tenant credit. There's a lot of businesses out there around the world that have been operating under the benefit of QE and low interest rates and availability of capital. And obviously, the WeWork co-working model is clearly one of the beneficiaries of that environment. Well, that obviously has shown some cracks in the lead up to the virus. Those cracks are now obviously becoming chasms, and so we will see some corporate collapses in the office space, not just of co-working, but also, as I say, other marginal businesses. And so the critical factor for office is to work out just what the permanent increase in vacancy is going to be. Frankly, most of our office exposure is pretty focused on what we think to be better cash flow, more resilient cash flow operators. So one of our biggest exposures is a stock called Alexandria. Alexandria is a leader in life science. Life science being predominantly research into pharmaceutical and other drug-related research, and so that vehicle is obviously probably going to be more relevant with greater work done in terms of virus, trying to find vaccines and prepare for future viruses, etc. So, we've been well placed with that stock. We've also, as part of a diversified portfolio, we've held a stock that's in the office area called Equity Commonwealth. Equity Commonwealth has a total enterprise value of about just over $3 billion US, and it's sitting on cash of about $2.7 billion. We've held that in the portfolio because we think that it's important to have a broad range of exposures. And so that stock, whilst it's office, it's only 10-20% of its enterprise value is office. The other 80-90% is cash. They're now in a position to take advantage of opportunities. So, yeah, broadly speaking, office is, I think, going to suffer. The extent to which is very uncertain. We simply don't know.
Okay, thank you. And so you touched on vacancies there, and some of the things that you've been talking about a lot in the past are the fundamental factors of the sector, such as demand, supply, vacancies, balance sheets, tenant credit. Can you maybe contrast the situation prior to the crisis and what your expectations may be going forward? And I know you just mentioned that it's difficult to anticipate, but what's the best you can do there?
Well, look, don't waste a good crisis. That's always the mantra of good investors. And the problem we've got is some of the down and out sectors. There's no doubt, I mentioned earlier, that some of the retail names are off 60, 70%. And ordinarily you'd think that that's great value. Well, look, we could well be proven wrong, but it's our belief, and as we've been consistent about this, that this area needs to be recapitalised. So we think the need for recapitalisation has been effectively compounded or accentuated by the fact that the cash flow from retailers is now under even greater threat. And we are going to see more bankruptcies in that space. And so with that in mind, we then look at the ability of the REITs to withstand that cash flow challenge. And we then look at their balance sheets, and we can see that they don't have balance sheets that are going to be able to facilitate the transformation that's necessary. And what I mean by transformation, I'm talking about a transformation to retail concepts that are relevant to today's consumer. Now, of course, what today's consumer looks like when we all come out of hibernation could be something completely different. And therein again lies the problem. For retail property, it will have to come to grips with changing consumer spending patterns. It's likely that we will see the e-commerce trend has actually been reinforced as more people get used to ordering online. I mean, I can assure you I've never ordered so many home delivered meals in the last couple of weeks as I have, in my life. That's just one micro example. So there is going to be some very dramatic changes in consumer spending patterns that have already been taking place that are actually going to change again. And so with those retail property vehicles down and out, you'd say, okay, that's a great opportunity. But as I said, they need to spend money to reposition their offers. This is not a cyclical period of weakness. They are going through a secular change, and they need capital to be able to transform. So therefore, we don't think that they represent value at these prices. Yes, I fully appreciate they're probably going to bounce and I'm going to look silly to some degree. But why would we go and invest our clients' money in a sector that we think needs fundamental transformation and a lot of capital to do so? So our strategy is that we will wait for the recaps, the equity raisings, to go in and participate through that avenue. We have to be patient, and that's the great challenge, no question about it.
So what are discounts to NAV looking like at the moment relative to the normal conditions, and how easy is it to accurately value the underlying real estate given this uncertainty? Obviously, you've touched on retail there, so no need to go a bit further, but are we likely to see some impact on the actual valuation of the underlying properties?
Well, look, we were talking to one REIT manager. What we've been doing, as part of what we try to do is talk to as many different market participants. We've spoken with actuaries, we've spoken with valuers, we've spoken with REITs, we've spoken with lawyers, we've spoken with a whole range of different people to try and get a sense. And it's fascinating, some of the smartest people we know, the summary is that they all acknowledge this is uncharted territory, and investing today is the word or the term used, which I think is quite apt, is ununderwritable. In other words, it's very difficult to be confident about investing in NAVs at this point in time because we simply do not know the nature of the cash flows. We simply cannot underwrite what the cash flow, how much is going to be retained, deferred, postponed, as I say, bad debts, etc. So traditional discounts to NAV, we're probably trading at 10 to 20% discounts. But in some categories like retail, the theoretical discount is probably 40 to 50%. But it was our belief that retail property was 40 to 50% overvalued. And so it's hard to get too excited. I mean, I guess you guys are probably familiar with a show called Shark Tank. I'm not a huge watcher of the show, but, it's where somebody goes along and pitches their ideas to supposedly intelligent investors with their latest idea. Well, imagine if I turned up, and I am going to talk about retail, Rob, unfortunately, because I think this is the problem with NAV. So I'm going to turn up at a Shark Tank meeting and pitch an idea, and I'm going to tell you I'm going to invest in an asset with an uncertain income stream that requires a lot of capital, that the tenant, the profile of income we're not quite sure about. There's massive changes in competition from disruptors, and I want to sell you that asset on a 20 times multiple. By the way, that's pre-depreciation and pre-tax. Well, I think any sensible investor would laugh at you and say thanks, but no thanks. And that was retail property. So the implied or the theoretical valuation of retail property around the world was a cap rate of about 5% or 20 times multiple. That to us was fanciful a month ago. It's even more fanciful today. So coming back to your question about discount, NAV, etc., it is hard to say. It is so hard to say in those particular areas. What we will say is quite positively, there are parts of the market where you can continue to be enthusiastic, and that is in the data centres, and that is in the logistics, and that is in the likes of cell towers, select healthcare. We've got, again, a stock we've highlighted in the past, Assura. It's been a fantastic performer. It's done everything we would have wanted and more. It owns 560 doctors' clinics in the UK. The doctors' rents are paid by the NHS. And so that income stream is looking better and better. So that's the sort of quality that we look for when we're looking for this, mystical premium or discount to NAV. We're focused on cash flow. We're focused on the quality cash flows. And our simple philosophy is the REITs that produce the most amount of cash to the least amount of risk tend to generate the best returns. And that's our ongoing philosophy.
I saw the incredible bounce in the Assura share price. It dropped with everything else and then bounced back above its mid-February high. I know it's come off a bit slightly recently, but yeah, as you say, the defensive nature.
It came off. It came off last night because they, quite cleverly, they're doing a capital raising. They're tapping into the fact that investors now better appreciate the quality of the cash flow, and that puts them in a stronger position. So, we're delighted with management's efforts.
And the other thing that's going on around the world is where some of the REITs or REIT industries are approaching government and to ease the stipulation to pay out or on the payout ratios to remain a REIT status, and we're seeing this around the world. What is your view on that? And do you think it's a good thing for them to be allowed to do that? Do you think, or do you think the better REITs will just continue to pay out their dividends? I think we've just seen Derwent announce that they're going to pay their final dividend in May or June.
Yeah, look, I mean, again, they're going to be able to, the stocks like Derwent for the moment, because you've got to remember many tenants pay their rents monthly, sometimes 3 months in advance. So in other words, we had pretty good visibility on cash flow through much of March. It's only going to be the next 4 weeks to 12 weeks that we're going to get a better sense of cash flows. Now, in terms of the flexibility around REITs and distributions, yeah, it's a dangerous game. You know, we promise our investors that these REITs are mandated to pay out their cash, and yet when things get a bit tough, they try and find ways around things. Look, at the end of the day, we've said all along, we're a total return investor, and we look at the risk of permanent impairment. If it means that in the short term we've got to sacrifice some dividends, then I think, frankly, so be it. Because we want the situation where they are able to, as I say, not be in a position to jeopardise their capital structure. And if it means retaining a bit of cash through not paying out distributions in cash and rather than paying it out, for example, in scrip or whatever, for a period, look, I think that's an acceptable thing. It's not ideal, as I say. We certainly don't want to promote that as being something we think is great, because it's not. But what we do want to say is that we should take whatever measures necessary to ensure the integrity of the vehicle. And that's why we continue to be total return investors and not focused on yield, because it just gets you too much into trouble.
And then in terms of leverage of REITs within the portfolio and perhaps the wider universe, it was looking better earlier in the year, but and what's your view on that now?
Yeah, well, it's interesting how the market changes its focus. As you know, we do focus on leverage, and we have a particular focus on leverage rather than loan to value, which we think is important because a lot of debt covenants are in loan to value, so we don't dismiss it. But we think the best measure of of leverage or financial leverage is debt to EBIT. Now, it's interesting at the moment. The problem is what is your EBIT? Because again, in some markets, people not paying rents, it's hard to understand what your EBIT is. And what is actually now all of a sudden fascinating become the key metric, which we haven't really thought hard about, quite honestly, for a while, is now interest cover. Because we haven't looked at interest cover because interest rates are so low. Everybody has good interest. Mm-hmm. But hang on a minute. In the event of a pandemic, you don't have sometimes any income, as is the case in hotels. All of a sudden, interest cover covenants become a pretty important attribute. And in fact, we've seen a couple of vehicles around the world, in fact, airports, actually going out and raising equity to ensure that they can repay any loans where there were non-bank loans, where there were interest cover covenants. So, it's fascinating to see how at various points in time, different measures matter more. And it's a very unusual situation where very low interest rates, but you can still reach on interest cover when your earnings all but evaporate, or at least the cash flow.
And I assume that you're also looking at the debt maturity profile of some operators as well, given that banks might be under pressure to not support them to the same extent going forward.
Yeah, look, what a lot of the sensible REITs did was they learned from the GFC. Any sign of trouble, go out and draw down your loans. Any liquidity you can access, go and draw it down while it's still there, in case you've got exactly what you've just described, where you'll have a short-term debt maturity, you're going to draw down any lines. The great thing is that, there is no doubt the REITs have generally deleveraged in the last, 5 years. And they've also been pushing out their debt maturity. So, the biggest real estate collapse, certainly in the listed space in 2009, was General Growth Properties, GGP. It collapsed because it had $9 billion of debt maturing in 1 year. So it was the sheer volume of debt maturing in a short period of time. The REITs have been ensuring that they don't have short-term debt maturities. They've been laddering their debt and pushing out the debt maturities. So we don't see any major issues on that. So yeah, they're in pretty good shape in that respect.
Okay, Grant, thank you. And for the rest of the time, I'd just like to talk about the fund. So, strong performance through the market downturn. I think you've outperformed the index by 8.5% in the first quarter, and the European peer group by about 6%. So, well done. Thank you very much. What have been the primary contributors to that superb performance?
Well, yeah, thank you. Look, honestly, it's nice to produce alpha, but it's disappointing to produce a negative return. So I'm personally disappointed about that, and I'm sure my fellow investors are too. It's not trying to make light of it, but I mean, this is why we've always said you've got to take a 7-year view when you're investing, because you are going to get these short-term aberrations, these short-term unforeseen circumstances that challenge us from time to time. Do not get me wrong. I'm not saying it's all good, it's all fine. It's nothing to worry about. All I'm saying is that we just have to expect that we are going to experience these sort of unforeseen drawdowns. That means that you've got to take a 7-year view. And so, I look back at that 7-year numbers that the strategy has delivered. I know you guys have only been with us for just over 3 years, but if we look back at the same strategy going back over 7 years, we think that's the way to look at total returns in that sort of time frame, and that's the way we try and frame things for very good reason. So how we've managed to do lately, look, I think it's fair to say, clearly we avoided the retail names. We've been had limited exposure to, as I say, the senior housing segment, underweight broadly, hotels, which again isn't a big part of the benchmark, but also our stock selection, Assura, which is 2-3% of the portfolio. That's a very small part of the benchmark. That's only 10 basis points, 15 basis points in the global benchmark, and we're about 200 basis points. Our exposure to the likes of Equity Commonwealth, again, this is a cash positive vehicle that's in a fantastic position to go out and take advantage of situations. Long Equinix, which is the leader in data centres, network dense data centres, an exposure to cell towers platform called American Towers. That also has obviously been benefiting from the dramatic increase in traffic, in data traffic and telephony around the world. So it's those sort of exposures combined with, of course, Prologis, the leader in logistics, that has also performed superbly well for us. So look, it's a mixed range of contributors. Alexandria, as I said, the life science leader, that's also performed very well. And a stock that has been a bugbear of ours in terms of it's been a bit of a challenge performer, which is a Japanese investment development company called Mitsubishi. We've been stuck to that stock despite I think I might have had hair before we invested in that stock, and I've since lost it all. It finally started to produce the sort of diversification that we hoped for. So, this is why we believe in a diverse portfolio. It doesn't always work for you in the short term, but you've got to have a good range of cash flows in different markets that hopefully will deliver at different points in time.
And so I know you don't particularly look at things from this perspective, but there's a large exposure to the US of 56%. Are you happy with that, or are you looking to lighten the position given the incipient downturn in the economy there?
Yeah, look, it's a good question. I mean, there you've got obviously the virus has had a particularly significant impact for a number of reasons. Let's not forget, you've also had, which people tend to forget also, the oil industry is going through a bit of a challenging period, and the oil and energy sector is a very significant part of the US economy. And so that also is going to weigh on, particularly on certain geographies. And then there's a little thing at the forthcoming US election, presidential election. So you're right, there is certainly enough to keep us concerned about the US. Our exposures there, we think, are the better quality exposures that should perform reasonably well. But yes, you're 100% correct. It is a market that is going to face some, pretty significant challenges in the next 3 to 6 months. But what part of the world isn't at the moment? We're all in this boat, the virus boat, the good ship COVID, and it's hard to try and find somewhere that's, dare I say it, immune to the effects. One area where we actually increased our exposure a bit in the last month or two has actually been Hong Kong. I mean, ironically, because it's really on its knees, and the stocks there have very strong balance sheets with virtually no debt, if none at all. So there's a market that's already been through a pandemic with SARS a couple of years ago, so it's basically experienced in dealing with this sort of situation. So that's a sort of an exposure that we've been trying to selectively go through and increase our exposure. But yeah, I can't say that we're overly enthused about the US market in particular, but the quality of the stocks that we hold there, we think continue to deliver what we want.
I know that we're still experiencing broadly net inflows, so there's no pressure to reduce positions. But what have you sold in the last month, and why? And then maybe conversely, what have you been able to take advantage of, any emerging opportunities?
Yeah, so look, we have, I think, selectively sold some office names. Dexus in Australia we've reduced quite significantly. What was disappointing today, the vacancy rate in Sydney's come out. It's increased from about 4.5% to about 5.9%, and that's without the impacts of this virus. So that was most concerning, and we'd already reduced our exposure largely to Dexus prior to that. We've been reducing exposure also to Boston Properties in the US, again on concerns about some of the tenant credit issues in that particular stock, as well as in Canada, long-standing position there in an office REIT there called Allied Properties. Again, a very good name, but unfortunately we think that the headwinds on tenant demand are going to be pretty significant over the next little while. So we've been definitely trimming our exposure to office names broadly. Look, there is one name I shan't mention. You'll see it in the next quarterly that we've been picking up a little bit of exposure to. It's very unusual office name, a fantastic cash flow. Fair to say it's already been a pretty decent performer, but we think that again the market's underestimating the quality of the cash flow of this particular vehicle, which is, dare I say it, and I don't want to jinx this, but it's a pretty rock solid tenant cash flow. So we are trying to selectively buy again diverse cash flows. Elsewhere, we've been basically any marginal smaller retail position that we might have had, we've probably cut, but again it wasn't meaningful to start with. So there hasn't, I wouldn't say, been anything that we've really had to, dare I say, turf out of the portfolio, because most of our positions we think are pretty good. It's whether or not they're now getting fully valued. We agree with that, but again, we think that people who are buying into these boxes are doing it very naively.
Okay, thank you. And then just last question from me is dividend yield of the portfolio. How robust is that? And I know, given all of the conversation that we had previously about the uncertainty over distributions, but it's around the 3% mark at the end of the year. What do you think the dividend will be for the rest of 2020?
Yeah, Rob, look, I'm not going to beat around the bush. I'm not going to answer that. We've never sold the strategy on yield, and we've gone to great lengths to highlight that. Yes, we've made it known that it has a nice income yield, absolutely, but that income yield is better than equities and fixed interest. So yes, I have to acknowledge we have highlighted that aspect, but I've never sold a strategy on being a yield product, and I certainly am not going to today. Given guidance has been withdrawn on earnings and dividends by most of our universe of stocks, I think it'd be incredibly negligent of me to go out and try and predict what I think the picture looks like. All I can say is that for most of our stocks, we're pretty comfortable with the cash flows, and I want to sort of reiterate that. I mean, I think we've spoken a lot about the problems at retail. We've spoken a lot about the problems in hotels and senior housing. They're not a material part of our portfolio, but they are important to the index. And that's why we've said we don't invest in the index. We invest in select real estate platforms. And we're pretty comfortable overall that those platforms are very well positioned to withstand this exceptional period of time. But I simply cannot give you any assurance or guidance about distribution levels because, for a whole host of different reasons, except to say, as I said, we think we're in the better quality cash flow names, and so that's all I can say at this point.
Okay, thank you. And just last question about you and the team. I know that you've been working from home, and I assume majority of the office are. How's that been? And is everything up and running? And how's your ability to carry on managing real estate portfolios?
Well, look, thanks for asking. Look, the team's well. We've been fortunate. We've got for a couple of things. First of all, we've got a multi-portfolio manager approach, or multi-counsellor approach. So there's 4 PMs. So, if one of us unfortunately is sidelined, or even 2 of us are sidelined for whatever reason, the portfolio continues to be managed by experienced, seasoned investors. And so that's where, again, we're very fortunate in the structure that we set up. The other thing is that, we've got somebody in New York, and about 4 or 5 years ago, I was working out of London. My point being, we had set up systems to be able to deal with people working remotely. And so the business has transitioned to this remote working environment very smoothly. And so we've been really pleased about how the systems have stood up. Now, I don't think any of us should be complacent about that. I think the systems are really being stretched. It's absolutely vital that we recognise the limitations of not being having people together to be able to converse and efficiently check on things and highlight things. And so it's absolutely critical that we really focus and concentrate on keeping lines of communication open in a pretty formal sense, and that's what we're trying to do. But look, it's fair to say that there's some of us that have got loved ones who have been impacted, shall I say, and it's a very stressful time. The market's pretty stressful, and but look, this is the great challenge of life to go through these difficult times, and we're trying to do our best for all concerned.
Good to know, and I assume, given your extent of your history and your reputation in the real estate market, I assume you're still getting good contact with the company management that you invest in or would like to invest in.
Yeah, look, again, I reiterate something I mentioned earlier. One of the things we've tried to do is to keep the lines of communication open, and we're going out and trying to get different perspectives, because I'm sure all of you know, sitting at home, it's certainly different, and you know what, it's going to make us appreciate different things more. But regardless, we do need to continue to communicate and not get sort of too caught up in the 4 walls in which we're all restricted. And so we've been reaching out to managers all around the world. We were on the phone today to someone in Singapore. We've been talking to North American, European REIT managers. We've been to Australian REIT managers. We've been talking to actuaries. We've been talking to bankers. We've been talking to lawyers. We've been talking to every different possible person to try and get the best possible rounded picture of what's going on. I can't tell you that it's become a lot clearer to us, but that in itself is quite telling, and that's why we remain cautious. We don't think it's time to risk our clients' capital on hunches, and she'll be right. Hopefully the virus is starting to flatten, but the economic consequences of it are yet to be fully appreciated. And so therefore, we've got to try and make them a sense of it by talking to as many different people as possible.
Well, thank you very much for your time today, Andrew. Really appreciate you joining us.
Again, thanks everybody for your continued support. We know it's obviously a challenging environment. Please, appreciate that we've always tried to give a balanced a view of the situation. We don't try and oversell our space. We still think it's a long-term area to invest, and that's been demonstrated by our longer-term investment numbers. This crisis will throw up opportunity. The listed market, the benefits of the listed market will become really apparent, we believe, in the next 12, 18 months because of the quality of the platforms and the liquidity. And so whilst I have a cautious tone, I'm actually quite excited about the industry because I think that the benefits of the industry are going to be reinforced. We're going to see listings of major real estate organisations because they cannot get liquidity, and that's going to give us great opportunities in the next 12 to 18 months. But there is going to be some choppiness. There is going to be some volatility. But again, we think great real estate is going to continue in the long term to produce we think competitive returns, provided that you're selective. And we haven't spoken about my little pet topic of the parasites of the index market. I think that where are they during these times? They're certainly not delivering any value whatsoever as far as I'm concerned, and so we'll carry on. But it's a great challenge, and we're certainly fighting hard.
Thank you. So to everyone listening, thanks for joining. I know it's not easy to stomach a drawdown in any asset class, but I believe from what you've heard today, investing in high quality REITs, holding high quality buildings underlying them, should recover should the global economy start to tick up. And in addition, the focus on the quality of the tenants within those buildings, their ability to emerge stronger from the crisis, I think that divergence might prove telling as we come out as well. The flexibility and appetite for Andrew and the team to move between sectors and regions as necessary is also an important toolkit within the global real estate investing space. So just finally, we've recently posted a podcast recording that I did with Andrew in London in February. Apologies for the delay on that, but there's some interesting views from Andrew going into the crisis. So take a look at that. It's on our podcast channel, and sign up and like the channel.
I'll be interested to hear what I had to say. I'm going to get pretty silly, I reckon.
No. Actually, I re-listened to it, and it's not too bad. And you had more hair then as well. And finally, a reminder: tomorrow we have Jeremy Lang from Ardevra talking to us about what behaviour is going on in the market moves at the moment, and obviously that's a key part of the way they invest. So thanks everybody for joining. Thanks to all our investors for the support, and please let us know if you have any questions. Have a good day. Bye bye.